Hey traders, Raghee here. Happy Wednesday, everybody. Welcome to Charts and Coffee. Great to see everyone. Hope everyone's doing well. We are in non-farm payroll week. Of course, we're dealing with the jobs number coming out on Friday. And, I don't want to sound, there's always this hyperbole. This next FOMC meeting is the most important one or things along that line. But since we have been fluctuating probably the most that we have in some time when it comes to what is it that we should expect from the Federal Reserve in terms of that target rate probability, this is the most fluctuation we've seen all year, And what I mean by that is there has largely been, and let me grab my drawing tools here. And I think most of you that have been following me in the free videos and following me in Charts and Coffee, you're well versed in this. So this is the first time you're hearing it. Really simple concept. Where we are on the trajectory to wherever it is that Jerome Powell wants to take the lending rate, right? Can be tracked with Fed fund futures. Now, they're not easy to read, right? There's a lot of contracts and reading the futures contracts and trying to determine what it is that a futures contract is telling us. So the CME, and it's an awesome service that they have made free, has what's called a countdown to FOMC site. Perfectly free, perfectly perfect, really. And what it does is it allows us to look at the the target rate probabilities as they are reflected by the Fed fund future. So for those of you thinking, well, what's a Fed fund future? Don't worry about it. It's all been distilled in this site. Most of the year, we have been seeing that this column, let's stick with some really basic concepts here. This one has been the tallest. In other words, the highest probability has been residing with the expectation that the Federal Reserve, by the end of this year, is going to be at 3.5 to 3.75 target rate. And that was also where we saw it flatten out going into next year. In other words, not only are we going to get there this year, but that's where we stop. And that's all easy to see when you look at each month and what the peak is and where it just plateaus. So peak, plateau. And that's been largely this 3.5 to 3.75 or 350 basis points to 375 basis points. All right, that being said, the 3.25 to 350, that's a new development. And what that actually means is that we're expecting one less quarter point hike. We're expecting 25 fewer basis points on the way to that target rate probability. And equities are going to like that. The column that's been sort of showing up here and there is this column. This column didn't exist really for most of the year in any meaningful way. It was single digits and low single digits at that when it did make an appearance. And if anything, it was this column over here, nearly 4%, 3.75 to 4%, that was in third place. Now we see there's consistently been even more, although this is not probable yet. It's just possible. This is probable. This is next most probable, right? And then this would be the least probable in here, right? Just kind of ranking them. So 1, 2, 3 in terms of probability. And you can see that half point less hike is showing up. Why it's showing up, frankly, doesn't matter, gang. I know you can say, well, it's because of jobs or it's unemployment or it's recession. Gang, nobody, including the equity markets, give a rip about recession. It's talked about on television. It's something to talk about. It's something to fearmonger over, but it's not moving the market because we've already had the GDP, negative GDP sequential, like 2 quarters. We've already had that. Why aren't we selling off? Right? Why isn't there blood in the street? Why aren't we crashed yet? I mean, this awful thing has happened, right? Because that's not what's moving the market. That's, I think, what's probably the most difficult for a lot of traders to process. By the way, we're up today, right? I had a lot of questions yesterday about the politics that occurred early in the session. Oh my gosh, Taiwan, why aren't the markets heading lower? Because that's not what's moving the market. But that's what fear mongers love. If you watch television, that's the fear mongering box. What is it that we're supposed to panic over today so that we stay tuned and watch their ads? That's how that works. That's not what's moving the market. What's moving the market is the Federal Reserve is very likely, for whatever reason, to hike less. That's the punchline. So I hope that makes sense. And because of that trend in the rate of change of the Fed fund futures on that graph, I hope makes sense to follow now. It's not really tough, is it? I have since the first week of July said, this is it. What does that mean? Is it up and away from here? Oh gosh, no. What that means is if I ever say, and I usually try not to use this jargon, but if I say, look, the bottom is in, I don't think I do, but I might as well, because that is what resonates with people. So let's define what that means. The bottom is in does not mean we do nothing but move higher from here. It should never mean that. What it means is we are far less likely, improbable, right? Not impossible, but improbable, to reorganize into a downtrend. In other words, gang, I don't think another leg, based on what I see, I don't see the data supporting or the price action supporting another major leg down. Why would we? Because we're going to wait till September or October to panic about the recession that we know is happening in August? Maybe. I mean, October is an unpredictable, trick or treat kind of month. I get that. But that's not a setup, gang. That's not a setup to say, well, October can be October, so that's when we're gonna sell off. That's not a setup, is it? Not at all. But it makes great talking points, right? So now what we want to remember is keep an eye on that. Keep an eye on the macro that feeds the Fed fund futures expectation. Growth, inflation, jobs. And we have a big jobs number on Friday. Could move the needle some. If that number is better than expected, the Federal Reserve can continue on their track to the two higher columns that are probable. If that number is lower, in other words, we don't create as many jobs, we could track lower towards the fewer rate hikes that I showed you on that. So that's how I'll measure what the market thinks about the data. If you watch every significant data release, if you watch every significant, for example, yesterday, when everyone was talking about a planned landing in Taipei, I went over to the Fed fund futures. Did anything change there? Nothing, right? So it's a headline, right? It's a headline. It's an idea. It's not a setup, right? So amateur hour is making yesterday's political headline a setup, and it just simply isn't. So I want y'all to keep calm and have a good process-driven approach to the market rather than jumping from headline to headline, which is meant to grab your attention. But it's not meant to grab your attention in a way to help you. It's just meant to grab your attention. So I hope that makes sense. All right. So let's jump on over to your questions. That's all I've got. We're going to, as far as I'm going to continue to focus on the short-term time frame day trades. I'm going to continue to stay nimble because what makes the most sense right now is to continue to just stay nimble through August, which I have experienced personally as being the trickiest month of the year. All months aren't great. And when we have the illiquidity and sort of the disinterest that August oftentimes, especially the first 2 weeks, often has, let's stay nimble and let's not expect longer term follow through. Let's expect chop. Let's expect range bound action. So today being up and yesterday being down is utterly meaningless, for example, on the daily time frame of the S&P. But yesterday we had two really nice day trading winners. And if you haven't checked out the free video, gang, I literally in that video taught you how I day trade. I mean, in that video yesterday, trading today's gap down, I literally walked you through how I day trade. So if you haven't checked that video out, please do if day trading is on your radar as something to do. All right, let's get to the questions, shall we? Kicking it off with Deborah. Says, good morning. Good morning, Deborah. Can you comment on gold and IEF? Sure. Okay, so gold is really stuck in a range still. It's up. But please remember, a market moving higher doesn't really mean it's going anywhere new. Gold hasn't gone anywhere new in 4 sessions. So there's really nothing. It's up today, but it's in the same range. So one of the things that'll prevent folks from getting wrapped up in a down day and an up day and a down day is ask yourself, are we going anywhere new? Are we just going back and forth over a very almost pacing? You ever see someone nervous, just pacing? You ever go to a speaker and they're kind of nervous to be up there, but they're trying to sort through that, and you'll find that it's pace, and pace, and pace. That's what this market is doing. That's what gold is doing, just pacing. So really nowhere new. And then IEF is a question about the 10-year futures, and that, of course, would be ZN. If we find the Federal Reserve is moving towards the more hawkish, let's go back on over here so I can show you what I mean by hawkish and not. So if we head on back on over to the countdown, let's go to December. So if there's a line in the sand, this is what we expect. Anything this way is hawkish. Anything this way is dovish, or favoring higher rates, favoring lower rates. I don't know why we use birds. I'm sure there's some analogy. I don't know why we use bulls and bears. Doesn't still make a lot of sense to me. Swiping down, goring, I don't know. But we have our animals, right? We have bulls, bears, we have doves, hawks. Hawks and bears would probably be a little bit more simpatico, while doves and bulls, traders are going to like lower rates. That's going to be a little bit more simpatico. So that's what I mean about hawkish and dovish. Where are we in terms of below 3.25, 3.5, or above 3.25 to 3.5 for the target rate probability? In other words, where is the Federal Reserve intending to take rates? Peaking, plateauing. Got it? If we are going to see higher rates, then bonds could sell off, because in terms of the yield, when bonds head lower, that's higher yields. And when bonds head higher, that's lower yields. I know. Why not make it directionally correlated? But it's not. So that's the movement. But frankly, we're still pretty choppy. We're still pretty choppy on the 10-year. And I say that not only because I have a mix of my red and green and blue grab candles, but because the way in which I assess the 8, 13, 21, and 34 EMAs, the way that I look at them, they're telling me, hey, Rag, yeah, the momentum is bullish. We can see that. The momentum is bullish, but the trend is still neutral. Momentum is bullish. Trend is neutral. That's it. That's it. So that's the way that I look at it. Do I still like it as a valid trade? If you're able to sit through the volatility without exceeding the paper cut limitations, if that criteria is met, then yes, Deborah, then yes. And that's always going to be the criteria. Can you afford to sit through the trade? Look, let's go back to bonds for a moment. There's probably a pretty good argument that right in here, that's probably going to be as low as the ZB contract gets. We don't know that till after it happens. So to even talk about the low was set, well, no duh, right? There it is. But anyone who, thought that maybe this was the low, or maybe this was the low, or maybe this was the low, right? Let's take the most recent one. Is this the low? Let's say you bought that because you're guessing at the low, which please never do. Unless you hate your money, in which case, guess away. We made a lower low here. Now, for some traders with large pocketbooks, that's about a 4 or 5 handle move. Maybe that was a trough that you could have sat through. No way to know until you're sitting through a leveraged futures contract and the number of contracts you buy, and sit through that and say, oh, that's what that feels like? No, thank you. Or, hey, my account size and my experience level, I can sit through a trough like that. Now, remember, this was the low, but we didn't know that as it kept going lower. So keep in mind the psychology that's running through your mind once we take out that level. Okay, so this ultimately ended up being the low. The reason I mentioned that, Deborah, is this space here. Now remember, we didn't know this, but unless this space was affordable, we can't sit through that, right? Same thing goes with GLD or IEF. We don't know where the markets are going to go. That's a fact. Nobody does. However, we do know how much we can risk. We can position size in such a way that we can make risk more favorable to our account size, but we don't know how low is low. So as long as you have a point at which you say, I'm either willing to spend, risk this much of premium paid or risk this much per futures contract, once that level is exceeded, that's it. That's it. Right. And that's the way I look at that. I hope that makes sense. Okay. Visa. What about Visa for a short? So if we're going to look at Visa for a short, let's build the trade from the bottom up. Neutral. Where is the neutral overbought zone? I think we have some really nice Darvis resistance here and here. So once we get up into this area here, and it syncs up with the stochastic, but the problem is we're nowhere near that now. So the specific level was overbought stochastic and the resistance level. So if you're already in it, JR, great, but I won't short it now. That's a momentum trade. And that's even kind of a late momentum trade. Although late is really, in fairness, late only is late if there's not much further to go down. I don't know how much further is to go, but I do know this area around 200 has some support. That said, the timing of the entry, if you want to short chop, is at the upper edge. So I would say it's bearish in terms of coming off the ceiling, but it's not an entry where it is right now. And again, we can say we're bullish or bearish. We can say, we're looking for a short or looking for a long, but it doesn't mean that there's an opportunity with the current candle or at the current price. That's a huge distinction a lot of traders struggle to make, where someone could say, yeah, I'm bullish, but are you buying? Not yet. I don't have a setup, right? Do you want to play baseball? Absolutely. Are you playing? Well, no one's thrown the first pitch yet. You see what I'm saying? And so keep in mind that ultimately what we want to do when we're expressing an opinion about, is it going to rain today, right? Yeah, but it doesn't mean it's going to rain right now. We were expecting a certain kind of weather, but we don't specifically have the clouds forming yet. You know what I'm saying? I hope that makes sense. And I think that's oftentimes a tricky one for traders to say, well, Raghee, bullish or bearish? I'm bullish. I'm bullish the equity markets, gang. I am not expecting the downtrend to reorganize. October be damned, right? In terms of, Black Friday, all the Black Friday, that's November, Black Monday and things like that. Macroeconomically, there's no reason for a downtrend to reorganize. But it doesn't mean that I've got to buy yet. I would love one. I would love a buy. We are looking actively. In fact, my Sector Secrets Mastery folks, shout out to you all. I sent out that alert of the list, specifically of the symbols in the sector they belong to that are double green. So that list, it's a short one, but it exists. It exists finally, which is great. How can we take a 5-minute double green? Asked Avi, JT. So serious, but not the 1 hour. I don't take it serious. It's what I trade. Right? I don't take it seriously. We have to pick a time frame to trade. I think everyone agrees on that. Okay, I don't believe in multiple time frame confirmation. Cascading time frames are not a confirmation to a follow through. It just means the market has been following through. It doesn't mean it will continue to follow through. So I don't use multiple time frame confirmation for price or for indicators, frankly. So you have to pick a time frame. If yours is 1 hour, then that's the important one to you, right? That's all. Now, remember, if I'm day trading, do I want to day trade on a 1 hour chart? I mean, it's slow moving. It's likely not going to set. Think about what we need. That's a fair question, but think about what we're asking and what we need. If I want to day trade, and that's why we use a 5-minute. If I want to day trade, I need a setup, I need a trigger, and I need follow through before the market closes, ideally before the London fix or the midday doldrums. So 5-minute time frame, due to the number of candles, it's going to give me those patterns. It's going to give me that movement. A 1 hour candle. Think about how long. Every candle takes an hour. I've only got so many hours before I've got to be flat at the end of a day, because that's what day trading is, right? So 1 hour would not suit day trading. But let's say you want to be a swing trader. The 1 hour might suit you just fine. So we've all got to pick the time frame that we want. It's not that there's a best time frame, gang. So it's not as if I'm saying a 1 hour is bad. It's just not one that I use. right? Chocolate ice cream is great, but it's just not my favorite. So keep in mind, you want to build a trade being realistic about the time horizon. And the reason I use a 5 minute is because a 1 hour is not going to suit what I need to get done for day trading. And that's really it. That's really it. So that's why I use the 5 minute. And I do not give at all a care in the world what the 1 hour says, because that's the 1 hour's world. There's a flaw in multiple time frame confirmation, which is the assumption that just because a longer term time frame is heading higher, but the shorter one is going to follow. And that's just not true. I think a lot of you know that, because multiple time frame confirmation is one of the first things we are all exposed to as new traders. And if it worked, we'd all probably be successful traders. The fact of the matter is, when I look across what the overlapping characteristics are of, and I've got the privilege to witness thousands of traders and maybe a few dozen really successful ones, none of them have, I shouldn't say none of them, some of them use multiple time frame confirmation, but that's not the commonality of successful traders, right? The commonality for successful traders is usually prioritizing watch list building and risk management and position sizing. So you'll find where the commonalities are for the greatest number of traders, where they overlap in their habits, is not ever going to be multiple time frames. Some use it, some don't, but it's not the needle mover that a lot of folks think it is. So I hope that makes sense in terms of time frame, multiple time frame analysis, and also time horizon. All right, gang, that is it for me today. Hope you all have a wonderful day, and I will see you all tomorrow, same time, same station. My sector secrets, folks. I'll see you in the room. We're going to start our day trading up.